we had little sessions kind of like this. We keep them short, and I told you right now he's on holiday or he sits in a cafe and he completely redoes the exercise, whatever it is, or completely redoes it. And I think that's just such a fantastic way to do it. All right. Okay. And he also said, okay, just like you did, he said, the next session, why don't we, or no, he wanted a session on not just doing the project finance in the project finance models, but valuing the assets. And I think now I'm really sorry, I can't remember who asked what or anything like this. I'm a little intimidated by people who come on the call. Uh, but so I remember somebody asked about this. We kind of had a debate. Should we get into to more details on the starting on this dramatically painful issue of circular references, which can be solved pretty easily with this thing called a copy and paste block, or should we go into valuation? So I thought I wanted to do the next couple of sessions, if it's okay, uh, uh, on valuation of a project, and then start to really understand the connection between and the differences, most importantly, the differences between project finance and corporate finance. And I'm sorry, I go a little bit crazy on this, is I would think if you ever wanted to learn valuation and learn corporate finance, you should start with project finance and understand that any corporation is, like I said even before, is a portfolio of projects. And then you can understand all these distortions and problems in corporate finance. So we got enough to start with. I'm gonna get started, and in case somebody's kind of coming on for the first time, here's what we do. I go through some theory first, and not just get straight into the modeling. And for valuing a project, I think that's really really important. And I tried something different here. Again, but let me just, our biggest rule, remember the rule is that, please, I beg you more than anything else to interrupt. If you can send the message, but it's hard for me to find it. Please interrupt. It's so useful to hear what you want to do, to hear your questions, to go back over things that are perhaps not so clear. So I'm just going to share the screen and get right into it. Now I hope I sent uh, I hope you got the email with the files, and I'm just going to get started right away so we don't waste time here. And so I'm just going to talk about some valuation issues. Now, here's what I did. I sometimes find these little cases that I call these the interviews from hell, when you're supposed to fill in a model. This is a model from some bank that starts with JP, okay? And this is part of their assignment was on valuation, and they had 6 hours for this. I couldn't get this whole thing, to get a whole big model built, to get a valuation built, to get sensitivity built, and to do what they asked for you to do in 6 hours would be, I tried it. It's not easy. So here's what they said about valuation. Valuation should be done using the DDM. Okay, if you're bank, you have to sound fancy. I would think that stands for discounted dividend methodology. equity value and enterprise value. So they already have something idiotically wrong, because enterprise value, you wouldn't use dividends, you'd use free cash flow alongside relevant sensitivities. And the buyer might look at your discretion, which sensitivities to highlight. Now I put in the associated model some sensitivities for pricing the asset you're supposed to triangulate, a word I can't stand, precedent transactions, and the bottom up rate derived using CAPM, which is just such incredible BS. I can't even start. I hope you see almost immediately why that would be such a problem. And anybody in project finance who would use this whole business of unlevering and relevering the beta, it's crazy, because that assumes that two companies have the same fundamental risk, and if you have more leverage, you have more risk. Well, that's the opposite of what happens in project finance. The bank tells you how much risk you have, and if you have more debt, they say you have less risk and all of that. I don't have to get into that. Then they say, assume a 7-year hold period, which if you look at real projects, the hold periods is a whole lot less than 7 years. And we're going to understand, if we understand the IRRs from our very first session, we see that the whole business is to get the cash as fast as you possibly can. We're going to see that. So that's exactly, we're going to do a valuation. But then they had something a little interesting. This is in South Africa, and they said this is the implied discount rate. I assume it's an equity discount rate. And so they have actual transactions. And that, for me, if you get action, that's the real cost of capital. The minimum amount people will pay, presumably there are bids. How people actually paid for the projects in a bidding kind of situation, they have to bid with discount rates as high as possible. I mean, as low as possible to get, a high value, and you're going to bid against other people. So this is almost like it really is a cost of capital. So here's what we're going to do. We're going to take this model. I'm not taking the one we did before, because it should have some more real world kind of things. And we're going to put a little flag in. And when we put a flag, we're going to compute a holding period. And then we're going to, with the holding period, look at kind of what IRR you earn. To get past this, I have to talk about this horrible little thing I did before. I look at a project finance as changing risk, and that's for me like a marriage. If you go on a date, there's not a very good chance that date leads to a boring marriage. Well, after you go on the date, that's your development period. Your risk kind of starts getting lower, because maybe you make a commitment, like a commitment fee. That's our engagement ring. And once people have signed contracts, that's all project finance is. Somebody else is willing to co-finance with you and take risks. That's like your parents putting money in and all that. And then everything changes at the COD, because then you got to move in together and you see, is this thing going to really work or not? Or is it going to be a disaster? Maybe this husband of yours is a complete messy pig or something like that. So after that, but after a little while, you're going to say, this is either going to work or let's get out of it. And then hopefully the idea is you have a really boring life, a boring marriage, and you have grandkids and all that stuff. And here, it's the same thing here. That to say up here, to say that you can put a CAPM here and have the same risks when you develop the project, when you build the project, when you have a financial close, when you start operating the project, and then when you have some history about the project, is a completely crazy idea. And our valuation better reflect that if we're going about 2 years after the projects begin, we've resolved all our development risk, we've financed the project, and the banks have put a contract in, we finished the construction, We've got some history on the volumes. If it's a solar project, a wind project, or anything like that, we've got some history about how it's working. We've demonstrated if it's in Africa or something like that, our ability to collect revenues. We've established what our operation and maintenance expenses really are instead of estimates. Our risk is dramatically lower. So I'm back to our little thing here. When they say 7-year hold period, and I didn't, they call this compression. I don't see, they call this compression, and they say, well, here's what I think a sensible process might be. We start at the end. We start at the end with these actual costs of capital that we can understand. Now, in these kind of valuations, if you've got a regular or a corporation, the big problem, the enormous problem, the impossible problem, anybody who thinks you can put a little formula in for the value of a company forever and ever and ever, that's the terminal value. The whole idea is crazy. The whole idea gets into the philosophy of the company gets rid of all its existing assets. It's got new management, new assets. Can it maintain the same kind of return that it earned in the past relative to risk? A crazy idea. In project finance, at least we have one project and everything's about the discount rate. Everything, because we have some cash flow. Well, we have cash flows over the life. We don't have to put a terminal value. And my suggestion is we start at the end and then we go backwards and we make a short holding period. And then we figure out what kind of, whenever we do this, if the rate of return that we've established on the whole project at the beginning is higher than what we sell the asset for, we'll get a higher yield. That's exactly what we're going to compute. And what we could do to really do this is figure out how high a yield do we need to charge to win the project and to win the bid and cover these risks that we don't have covered in the beginning. To say you can do that with some kind of capital asset pricing model is just so crazy. Now, so what we're going to do is we're going to open this file. I'm going to open it for just a minute. So the first thing we're going to do in this file, oops, I have this one, I hope. Okay. We're going to leave all this stuff at the beginning in any project finance. Now, this time I used an annual model. And I said, okay, we're putting some regular old solar kind of assumptions about degradation, availability, how much solar power you're going to get at first. That's a big one because these are all based on estimates and we don't have any idea how these were going to work until after we have a couple of years of history. That's the idea. And then we're going to go work through our CapEx, our OpEx, and our revenues. Any project will do that. And what I keep saying, some of these projects, I just don't understand why the very first thing you don't compute is the pre-tax return. Now, these are high returns. This is an example from India, and they all said they want high returns.
And go on it, yeah.
Sorry, okay, I think, and then what we're going to do, we put some taxes in that we didn't put last time, and then we started talking about debt, and I wanted to get into this a little more, and we are going to get into this more. We're going to put some debt, and they use a downside case. I'm not even going to call it a P90 case. They do what bankers used to do when I was a banker. They sit around a table and say, what's the kind of worst or low case, a reasonable low case, not a disastrous low case, a reasonable low case, and can we cover our DSCR and all that stuff in this low case? So we're going to start with that. We're going to get the debt size. You're not going to do any of this, but I hope you can kind of see how it all works. And then just a minute, then we put our financing in, and I'm all the way down to line 200, and I put a little copy and paste block down here, so all of that's okay. And finally, we start to fill numbers in. And I want to make sure that you can fill in the equity IRR and get the equity cash flows. I want to make sure that you can kind of do a basic kind of goal seek with a macro to see what kind of price you would want to achieve that IRR. I think that's already in here. We're going to talk about financial statements for 1 or 2 minutes. I think financial statements are almost well, they're relevant because you always have to do them, and they're relevant because you can check your model. So we're going to compute the earnings. We're going to make sure you get a balance sheet. And then we're going to do the key part, which is make a valuation from all this stuff. And we're going to use some, we're going to have some flags where we say we need to make things flexible where you can value the asset based on different kinds of holding periods. Are we going to have a 4-year, a 5-year, a 2-year, a 1-year holding period? The answer is going to be, it's always better to have a short holding period. I don't care what the cash flows look like. I don't care if you use equity cash flows or free cash flows, but you can't have the holding period has to be enough so that the buyer of the asset sees some actual history. And then we're just going to compute some valuations. Now, when we do valuations, here's the way a project works. The cash flows, in this case, there was some inflation of cash flows. This is equity cash flows where you pay off the debt and then whatever first. So this is the valuation. This is the present value of the cash flows. When you get to the end, there are no cash flows left. Like me, I'm old. I have no cash flows left. My value is going way, way down. At the beginning, even if the value of the project, this is the present value of cash flows of a project, it goes up, but it's a lot better sell here than here. This addition, and this is going up because we've got some inflation of cash flows. I just want you to kind of understand that before we get going. So these are the assumptions I showed you. And then this is what I wanted to tell you. And I've made this mistake now, I've realized so often. If we sell an asset at the end of the period, and that's what we're going to do, is we're going to pretend we sell an asset at the very end of the year. That means we don't get any cash flows this year, but we get some next year. If you don't sell any cash flows this year and you get some next year, if you have an annual model or even a semi-annual model, or even if you want to get extreme, a monthly model, you don't get all the cash flows at the very end of the period. You get the cash flows sometime over time. I suppose if it's semi-annual, the dividends, you might have to wait for the end so you can do this. But just in general, in valuation, there's this little problem of timing. The timing is not consistent between you buy the assets and sell them. So I'm going to have you do a little exercise to show you how you can make these sort of adjustments. That applies in all kind of discounted cash flow issues. And then here's what I'm going to do. The very first session we had this thing where we went to Python and got the stock prices. Well, you can go to finance.yahoo and you can do two things. One is you can get, if you use the Python, you can get 5 years of cash flow on any company. If you pay, which I did, I really did pay this, a few $100 to finance.yahoo, you can get a lot more data from way back more than 5 years. And what I'm doing right now is showing you a key difference between project finance and corporate finance. This is a really boring company. It's a utility company, and they earn the same kind of return year after year after year. And then you can say, well, what kind of value do they have relative to the balance sheet? What's the price of the stock compared to the amount that investors put into the company? For me, that ratio says so much about the past. It says, are you earning more than your cost of capital? Did you, as a company, make decisions and make whatever strategies so that you can produce more value than what you put in. It's the out divided by the in. But if we look at this, and I'm going to have to increase the screen, if we look at financial ratios for a project, this return on investor capital always starts high and goes low because we don't have any future capex, because our capital is depreciating over time. And if you look at return on equity, because of the way we change the capital structure, it goes completely crazy. So we can compute some of these financial ratios. It's more useful to show you that they don't work. And let's look at the enterprise value, which is the net present value of the project cash flow, not the equity cash flow. That's why that DDM comment was such an idiotic comment at the very beginning. In this case, they keep reinvesting about the same as their capex. This should always be more than 100% because of inflation. We'll talk about all that stuff later. They had a reasonably constant and low. This return on invested capital is like project IRR. And then if you look at the enterprise value to EBITDA, it goes down because EBITDA is either flat or going up. That's on the bottom. And enterprise value is going down because you're getting old. So these ratios always decline. And anybody who says, I can make a valuation using some kind of EV to EBITDA or PE ratio or something like that, they just don't understand the most basic kind of thing about project finance. But remember, this occurs in every corporation like General Electric. It had some really high returns, as everybody know. It was floundering and going down. And I'm sorry if somebody's from GE here, but it was going down. But the ROE, the returns were going up because they weren't reinvesting. If another company is reinvesting really, really fast, they're kind of like project finance, and they're going to have a relatively low return on invested capital or something like that because they're at their growth stage. Just going through project finance makes you understand some basic kind of things about interpreting any kind of ratios. Now, what we're going to do now, I'm a little bit afraid of this, is we're going to take our valuation of our project and we're going to make a pro forma M&A analysis. And what I hope to do, I haven't done this for a while, and to be frank, I haven't even done it in project finance, is we take our valuation and we put in our assumptions about how we're going to finance our acquisition, and we're going to make a sources and uses during the transaction. And after we make a sources and uses here, and then I'm finished just about with this. After we make a sources and uses, we're going to, so I left this time, I left the stuff in here for you. We're going to make a sources and uses and go through just a tiny, tiny, tiny bit of accounting. And then we're going to take this whole thing and make a pro forma financial statement out of this, out of the whole thing. And all we have to do is use a bunch of lookups so we can change the transaction date, grab things from our financial model. This is like a financial model of the acquirer. Then we transfer some variables and make sure we get the right kind of, if we take our financial model, we get the right column that's all getting all the dates just right and being able to do it carefully. After we do that, then we're going to go all the way down and say, well, what happens if we refinance some debt? Because here's what happened. I'm going to go through this. This is this case study. Actually, some things were really good about it. They went through and said, oh, I forgot what this is all. You're supposed to make a 3-statement financial model. Okay, good. Okay, you're supposed to you're supposed to put in the basic kind of ideas about this project. It's got a purchase power agreement. Then it's got some operating costs, and you got to mess around and put inflation in there. They have some exchange rates. But then they said, we're going to put some acquisition financing and we're going to maybe refinance the existing bonds. And then they had all this crazy stuff, which I don't believe. They said, oh, we're going to extend the life of the asset if we buy the company. We're going to be able to figure out how to clean the panels better. These are synergies. These are supposed synergies, which, okay, if you can get them, great. So here's the refinancing, and that's kind of the end. And we're going to do the same sort of thing here, okay, and make our little model and go all the way down to the financial statements. Let's see how, if we don't finish this, it's obviously, who cares? We're going to keep the sessions to a reasonable amount. And now all I need is somebody to help me out. And so I put, by the way, I put these little cases in, and I hope I left this on the base case. This is kind of the same thing we did before. You can see it's all the same. And can I have anybody volunteer to do some of the Excel? Anybody brave? Jess, you're going to be.
My offer stands. Yes.
Your offer stands. I'm trying to just. I don't want to. Manish, did you say yes? No. That's okay.
Sir, I just joined actually, so I have.
Oh, no. I thought you just had your microphone off. That's all. Okay. How
Just
about
joined, sir.
Abdul Haki? You want to do a little of it?
Yeah, let's try. Let's start. Then, if I get tired, then maybe we can. Somebody can change me.
Okay,
Yeah,
it's not
okay.
going to be so bad, I promise. Okay, could you just share your screen?
I need to open the Excel, right? So then I will be using my Excel.
No, how about this, Abdul Haki? Next time, Josh, I'm going to go back to you. Because I noticed with Josh something kind of interesting. I saw some improvement even just from the times. So let's do this. So this is named exercise. How about this? Yeah, and this, you've got the macros enabled, Josh. Sorry, you're on mute, Josh. Sorry about that.
My bad. Sorry.
No.
Yes, I have initialized the generic macro sheet
perfect.
a moment ago and unblocked this particular sheet so we can do the macros. Yes.
So everybody knows that. Everybody knows that. So let's just go. This time we're just going to fill in a few of the lines. So could you switch it to the base case? Okay, I set this up with the base case, and I put now at some point we're going to talk about circular references. So an interest during construction. I put 2 years of construction, and then yeah, very good. If you could just increase a little more, maybe. I said it's kind of like that case study. I said, oh, okay. What we could do is put a longer life into this project. We could put a improved whatever efficiency with the performance ratio. We could maybe get lower degradation. We could reduce the O&M. So those are supposed to represent the synergies this time. So that input C idea where you clearly lay out things in a nice, organized way is such a key behind doing anything. Let's move to the financial model and let's just start filling in a couple of these things. Hopefully, they'll just take a few minutes. So we could, if you go down, let's find the yellow stuff, okay? So, very good. It's way down there. It's past all of it. There, we had one, we just missed one up there. Way up a little higher there. Keep going. So the first thing is to kind of understand, where was it? No, down a little. I'm sorry. I'm sorry. So we have the depreciation. Now start going a little more slowly.
Yeah.
Whoops, is it even further down? It might be even further down. I'm sorry. This is all the debt finance. Then we, at some point, we have our two cash flow statements, one prior to our wedding date, our COD, one after the wedding date. So that's, so could you, I think, just go down to that yellow line, okay? And let's just compute the dividends. Now, this is a very simple cash flow waterfall. We could spend so much time on this, it's ridiculous. But let's take the EBITDA minus the taxes minus the debt service. So that's our last subtotal, and that's our dividends. And that's the big cash flow item we want. And then to get the equity cash flow, Abdul Haki, you're supposed to just ask your question. You don't even have to raise your hand.
No, in my model, I have lots of glitches. I don't know why. Like, I don't see any numbers, just saying names, and then
So
it's
you
giving
have to absolutely, number one, when you open it, you have to whatever, unblock it. Number two, you have to enable the macros. And if
Okay.
that doesn't work, we can just follow, I think, because we'll go fast here.
Okay, sure. Thank you.
But just make sure you enable the macros. That's the biggest deal.
Okay.
So then go to the net equity cash flow, which is just when we computed project cash flow, we did it pre-tax. We needed to really do that after tax as well. The after-tax project cash flow, CapEx, is the outflow. The inflow is EBITDA minus taxes, but minus taxes pretending you had no debt. So that's minus the, you call those operating taxes, and you just take the dividends you get in your pocket, like the EBITDA minus the taxes, go up to the dividends, and then the yellow one minus, and go upstairs and find in the sources and uses of funds the equity you put into the project. A little bit higher, I think. Sorry. Keep going. There. No, a little. Yeah, there. It's right there. Do you see in line 164? It's the last line of the sources and uses. Well, really, so 184. I meant 184. Excuse me. I didn't see it correctly. So that's the amount. That's the equity investment. Press enter. So that's all after debt service. And now, if you go down, we could get into a little bit of an argument about this. If you have a semi-annual model, remember we spent a whole lot of time on the timing. Well, the idea is you're not allowed to pay any dividends until you've paid off your debt service. So the true timing of when you're going to pay dividends and the true timing of when you make the initial investment is month by month. The true timing is the end of each semi-annual period. So we have an annual model, but can you compute the equity NPV? And I hope you can see down there that yellow one. And if you put that equity NPV and put equal, no, IRR, sorry, IRR, compute the IRR. XIRR, use XIRR even if it's an annual model. So go down, yes. Oh yeah, do it there. I'm sorry. Very good. Sorry about that. And very good. And so that's why we take the end of the period. Very good. Josh, amazing. Okay. And then go down and then take the NPV. I made a target IRR of 13%. So take the X NPV and do the same thing. And that NPV, very good. You use the target IRR. So that NPV is going to be positive. Okay, that's our basic kind of rule, which is the bad way to think about an IRR. Now, if you want, let's do it manually. You see, I have those little things there. If you just make that NPV equal to 0 by changing and go this time when you go to the input C sheet, we're going to change the PPA price. And if you go down a little bit, we'll change it in the blue area because that's the scenario. So we're going to change that price. So let's go back to the financial model and just do a goal seek. Now this is the big first macro you might ever do. That's my first macro. You go to that. Let's do it without a macro, but because we do it so often, it would be great to put a macro around it. Don't bother with this yet, Josh. Just go to data and then what if analysis, and then use the goal seek, click on the goal seek and set that to 0. Just leave that and set that to 0, the next one to a value of 0, and then go to the input C and change that PPA price. Okay, and press enter and press OK. And oof. And so now that's the price that would give us a 13% IRR. Could you could you copy that price all the way across? Let's just make that price the same all the way across. Shift Control R would do good. Or just however you did it. Perfect. Control R. However you want to do that. Okay. And then if you go back to the financial model, if we could get these little synergies they talked about, can you just switch the base case annual way at the top? I hope I didn't mess this up. Just change it to the longer life. So this is the idea. You're going to buy the asset and say, we get a longer life. Our IRR went up to 14%. But that's not really our IRR, but that shows you. And then if you go to the next one, can you just go to the next one after that? And this is, so if we prove that, oh my gosh, to switch the next one, I think I did something wrong on that. Oh no. Okay. Keep going. Well, we'll just leave it on the longer life. I had, can you just go to the base case, go to the input C for a second. I'm going to pretend that I made this on purpose. Can you go to the scenario number 3 where things went crazy? And that's where what did I, no, go back to, that's the one where it went crazy. Just a minute. Can we look up the S-curve code? Oh, change that S-curve code to 6 on all the rest of them, okay? Change it to 6, at least on the next few. Good. Yeah. Okay. And then a few of the ones at the end won't work, but let's see if this worked better. So go to the financial model. I could pretend I made that error on purpose, which I didn't. And then, but that you can see our little conditional formatting. Now go to the next one, Josh. And okay. The reduced O&M should have, forget the higher cost one. We're going to stop. Those are supposed to represent the synergies, okay? So let's go back to our first case. Let's go back to the base case. Great, okay. And then let's keep going down. So that's just the equity cash flow. Could you just compute, if you're going to do a financial statement, just go down to this financial statement. People have these rules that drive me crazy. It used to be, I called it the shell rule, that in the financial statements, everything should come from somewhere else. I think that's so wrong now. Just go to the earnings, go to the EBITDA minus the taxes paid, EBIT minus taxes paid. Fantastic. Amazing. Okay. And of course, we have no earnings. You have negative earnings because of depreciation. Depreciation screws up everything in project finance. And I'm going to, in another session, maybe in the next one, I'm going to talk about how to fix this. Again, that's going to be theoretical, but it's ridiculous. It's ridiculous. If we switch around the depreciation, we get a reasonable number. Let's go down. And then if you make a financial statement, the next thing I would do is make a cash flow statement, and everything comes from up above, and that classic cash flow, operations, investing, and financing. And you can see that kind of how that works. Can you go down to the balance sheet? And in the balance sheet, the stupid shell rule would be every closing balance should be from above. What crap. What you can do is just go to the cash flow statement and the profit and loss statement and put things together as the accumulation, except for the equity. Put the opening balance equal the prior year closing balance. So I just want to make sure that, and then go down and put the paid in capital and just go up to the cash flow statement. And right now, do you see it's right there, equity raised. Just click on that. You happen to be on that, press enter. And then we have the income, and put an equal sign and go upstairs to the income. You notice that's the last line of the profit and loss statement, right up there. And then press enter. And then on the dividends, be careful. Well, the dividends, put an equal sign. Just go up to the dividends, and that's, I think, a negative cash flow. And that's in the cash flow statement in the financing section, right there, the dividends paid in line 306. Press enter. Right, I'm sorry. Very good. Thank you, Josh. Oh, press enter. And then you can press alternate equal if you want. Try that, Josh. Alt equal, because everything's just being added. Alternate equal sign. Press enter. And then select the whole area.
So Ed, to be clear, isn't one item being subtracted?
The dividends have to be negative, so I cheated. Very good.
Okay.
It's negative in the cash flow statement. I
Fine.
was thinking about that. So can you select all of them and then copy them? Okay. And then if you go down, then, oh, look at that. The balance sheet balances, the difference in line 331 is 0. And then you just put a little round. And then if you go all the way back, that's testing whether the difference is equal to 0. And then if you go back to column G, you can see, we put a little and statement next to the true. Okay. Very good. So that's just a little bit, but again, these balance sheet and income statement make it just, we can't get any financial ratios out of that. If you keep going down, I put some financial ratios in, but they are meaningless. They don't tell you. If we've got negative ROE, that doesn't mean the project's bad. That does mean if you're going to do one of these exercises on an M&A, when you put the existing company, it's going to buy a project, the earnings are going to look bad. There's going to be a dilution in earnings per share. And we can't look at the ratios the same way you can in kind of traditional things. Now let's keep going down. Now, when I did a valuation, I put, first of all, I just repeated the equity cash flows, project cash flow pre-tax, project cash flow after tax. We could use any of these in valuation. The first two compute the enterprise value, the debt plus the equity value. The last one is just the equity value. Now, I've studied this fascinating company called Ørsted, who does the offshore wind. They are non-project finance, and they use something called FID that Josh just said, which is final investment decision, which for me means nothing. I'm sorry to be such an ass about that. For me, the real number in project finance is financial close, when the banks commit their money, when the banks commit 80%. Ørsted spent billions, and they've just been killed by the horrible changes in rules and all that. They had enormous political risk, but at the time they made their FID, whatever that meant, they had already spent an enormous amount. So whatever. I don't know why I got off track a little on that one. But Ørsted, they'd sell their assets. They're not project finance. They'd sell the assets and you'd have to assess the enterprise value. Another company, if they've already optimized their financing, you might look at the equity cash flows. I'm not saying which is the right answer. You can debate and argue with me on that. Now, what I did in line 360, let's go down to 360. We're going to sell the project after it's a certain number of years old. So if you go back one and put a plus and go up to the operating period in line 10. Now this is violating all with a mouse. That's that one. This would be violation of all sorts of rules. Press enter. That's just a little counter. If you, shift control R, I hope that still works. So that just counts how old we are starting at our commercial operation date. And then the key for me for refinancing, for valuation or anything, and maybe it's too obvious, is putting the date we're going to sell the asset. So if you go down to the next one, let's just put a regular old flag. I don't care if we use well, let's do it right, I suppose. Put an equal sign, go up to the one just above, and then put another equal sign and go to I guess you better go to, I can't remember, go to that one, go to G instead. I can't remember what I wanted to do, and press F4. Okay. Josh. And then how about shift control B? Shift control B right now works too. Okay. And so we're just putting a flag for that. Now, that's when we're going to sell the asset. And if you go down to the next one, then anything before that. Now I'm going to sell the asset right at the very end of its life. And if you go up again, let's put an equal sign, go up to the plant age, up one, and make it less than or equal to. So if we sell it right at the end and go to the same 4 over there, that one is fine. Very good. Enter, and then enter, shift control B and shift control R. Okay, and that means any cash flow that we've taken out of our pocket or any little bit that we've got into our pocket before the very end of year 4, we're going to get that money or pay that money, and then we're going to get the value of the project in year 4. That's how it's going to work. Now, if you use that little spinner box, you can see how that works. That's not a big deal. Can you just change that to a 5? So all I did there was said, okay, let's do a little bit of sensitivity analysis on when we should sell our project. And then if you go down, now what I did in the next thing is let's put a discount rate in. Now the big deal is very good. How about putting it back to 4? Oops, I don't know that worked. Undo that for a minute, because that wasn't an input. That came from the, so could you just, here's what I did, push that down. And so, no, I meant undo that. I mean, just lower the number of years. Sorry about that. Just control.
No, that's fine. That's what I'm trying to do, but I think it's the spinner that will not allow me to go. Maybe I have to go back to the input sheet and then change it here.
Okay, you should change that there, but that should have. So delete that spinner, cut it. So the idea there, and go back to input C. Very good that you're doing this, and right click and just copy that one. And
this spinner?
Yeah, just copy that. Now, when you copy that and put it over there, very good. Just go to the financial model, then right click on the spinner. And when you right click on it, go down to format control, and it better have the sheet name in it. See, it goes from 1 to 20. And it's changing it in that other sheet. So it should be okay. Press OK. It doesn't matter. So again,
so it goes
Abdul
up, no
Haki,
problem.
He changes it. Now what I did is I filled it in for enterprise value, but we're going to fill it in for equity value. Leave it at 6. That's fine. So go down. So I said, okay. And for me, here's the really big deal. And we could debate about this and think about this a lot. But I think a solar project is a great example here. If you have a solar project and if some insurance company or pension plan is buying or fund, you've got all these funds buying a solar project. The other day, some really nice guy from the UK was telling me about all this AI he did. And he said before he started working on this AI, he was working for a fund. The only question I had for him, AI was all very good, but I said, I have to say that politically, you can't say anything else these days. If you, the only question I wanted to know was what's the discount rate you used in buying your projects? Nothing else. And I would say that discount rate for the equity cash flow should be a little bit above the cost of debt, perhaps. Okay, I'll even give you that. Some people could argue it's the same or less. And that seems to have been the case. So right now, I said, even though, remember,
Sorry about that. Can you repeat that, Ed? I just didn't get it.
yeah, I'll try to repeat that, but it was a lot of BS.
No, that was the last part. Very interesting.
I would say if you try to think about as safe a project as you can imagine, a really safe project depends on the sun going up and down, and you've got history on actually how much solar is actually produced. Thank you for stopping me. You've got some history and you're comfortable with it. You know that whenever you look at solar projects, there's not much different in sunlight, but year to year. And you can say, oh, it's cloudy today. It wasn't cloudy last year. Over the course of a year, it's very amazingly similar when you look at all that stuff. O&M expenses is small anyway, and the big risk on O&M is insurance. But if you've established that and you said, okay, we've got a couple of years of O&M, that's small anyway, we're safe with that. If we're actually collecting the money from the off-taker, that means we've not got a problem with collection. We've already spent the CapEx, we've already done the development. The risks of this project are very, very small. That's kind of my point. If you go even crazier and say, this solar project has inflation protection in it. So if there's a change in the inflation rate, we get an increase in our revenues. You could argue that that's a lot safer than debt, because debt, if there's a big inflation, the value of the debt goes away. If there's inflation in the PPA price, you could even say that equity is less risky than the debt. I'm going too crazy with this, but I just want you to start getting to understand some of this. Now, sorry about this. Before we do this one, could you switch over to the half-year issue in the next one? I'm just going to have you do a couple of these. Now, how do we if you make it larger, does that take away the little? So if we a little bit, maybe one larger even, Josh, it doesn't really, oh no, oh, sorry, could you click on G3, just shift control right arrow, not shift control R, and then press control space bar, and then just make them a little wider, make one of them a little wider, and they'll all be wider. Okay, and then go back. Now, if you go to here, can you go back down to column 7, row 7 and F7? If you would use up there, press F2, we don't even have to do this. If you press F2, if you use XNPV, just you notice we're using annual data. We're using annual data, and we're assuming we're discounting this to 1 January of 25, and then we're assuming each period comes in a year. If you go down to the next one, what I did in the next one, if you press F2, I said, no, we're selling at the end of the year or the 1st of January, whatever, but then we get our cash flows in the middle of the year. So I just took those same cash flows but used a different date. Do you see how that increases the value? And these little timing things can be, well, somewhat important. And if you go down to the next one, I said, if we just use regular old NPV, that just doesn't really work because it always discounts 1 year earlier. So press enter. If you go down to the next one, it says start there, and that gives us like as if we're doing annual cash flows. And go down one more. If you take this one and you multiply that by 1 plus the discount rate and raise it to the half year, 1/2 year, it gives you the right answer, which is up in line 8. Or you can do it all in one go down to the next one, press F2. So we just take regular old NPV, we multiply it by 1 plus the discount raised rate to the 1/2 power. That's just kind of a problem in valuation that I have a lot. So let's go back to the financial model and try to apply this. And I'm getting a little bit afraid. Okay, and so what you do is just let's use that and put equal. Now, again, in this case, the IRR you earned, if you start that IRR we computed was 13.67. I hope it's still okay. I don't know where it came from. Don't worry, that's the one we started with. Let's go down and make that. Is that right? Was that right, Josh?
Yeah.
It's just use regular old NPV since we have an annual model, and open and then go up one, and then we're going to take the cash flow, equity cash flow from the next period, not this period. So go up to the equity cash flow, which is a few lines above. Keep going up. Keep going up. That's all our. Keep going up. I'm sorry, a few, more than a few. A little bit higher, a little bit higher, a little bit higher. Right there. I put the equity cash flow, but don't start with that one. Start with the next one. Go. So that says we're going to sell the asset at December 31st at midnight. And we're going to start collecting our cash flows or paying them in the next year. Shift Control right arrow. Okay, and you can argue with me about what kind of assumptions you should really make, but I just wanted to highlight the issue. Just press enter for now. And then to make it a half year, go up to that formula again and right at the very end, multiply it and open a bracket and put 1 plus the discount rate just above. And then raise that, close that, and raise it to the 1/2 power, I think. So put a little caret 0.5. Or 1/2 is good too. Yeah, fine. Okay, so that's our value. Press enter. And then, everybody, Shift Control R. What I do here is as soon as you do something like that, how about going all the way back to column C and get the NPV of the cash flow all the way back. Shift Control right arrow, not Shift Control R, Shift Control right arrow a couple of times, and just press F11 one more time. Okay, and then we've got probably way too many zeros. Ooh, well, press F11 anyway. Okay, we should get rid of all those. And the value is going up and then coming down. That was a waste. Let's just delete that. Let's not waste our time with that. You can use our NA trick. I think we've done that a couple of times, but we'll do it again. We'll show our value. In fact, what I did did I put a graph? If you go to the valuation summary, that just shows how the valuation of the project comes down over time. Okay, very good. All right, and then it goes up because we've got this one had some inflation in the cash flows. Let's go back to our financial model. Okay, and then let's again the idea here is we don't have any terminal value. Now, some people ask about valuation and all this, and we really should take another example sometimes where we say, okay, let's take a regular old corporation, and be mean and fire people and do all that stuff, and then buy it and then sell it, and then we can't go to the very end like that. But for now, I think it's an okay way to start. Now let's
So,
get
Ed, before we continue, can I confirm? So the formula we're using here is we calculate the NPV. Conceptually, it's not entirely clear to me what are we achieving with a half-year index.
So what we're doing is we're selling the project at the end of the period. And then in the next period, instead of waiting till December 31st to get our money, we say, no, that's crazy. And so, Josh, it's a great question. Instead of that, we're saying, oh, we really kind of get money over the year. We get money starting January 1st to April to May and all that. And the closest approximation to that is to take the middle of the year. So that's just like a classic kind of valuation based on annual cash flows. We have one transaction period, and then we don't have to wait a full year to get the money. That's all that does.
But if this was a quarterly or a half yearly
Then
cash
we
flow,
wouldn't have to make the assumption.
Yeah.
You're absolutely right. Because especially if you have, well, it's tricky in project finance. Here's why it's really tricky if you really get advanced. While you're paying off the debt, that assumption would be exactly correct because you're not allowed to pay yourself dividends until the semi-annual period when you pay off the debt. But let's say you have this crazy Africa kind of projects where you have a hydro project that it really lasts 100 years, but we have a concession period of 30 years and we have a debt of 15 years. That last 15 years, you don't have to wait anymore. In that last 15 years, you don't have to wait, and you get that cash flow you get is a little bit faster. So you got to be really kind of careful with the timing assumptions if you're really going to compute the value carefully. So very good, Josh. Okay.
And then on a related note, if you're still working on a half yearly or a quarterly time step, but if the interest, if there is value in recognizing the cash inflow from sale the next day after the sale, after the selling date, as opposed to in the next quarter, you see, because according to NPV, you will realize it in the next quarter, right? Which is the next time window, as per the model.
At the end of it, right?
Right. So there is value if it's a large sum of money. There's value in realizing it 90 days ahead as opposed to at the end of the quarter.
So you could you could put some interest income in, and you have a little cash balance. That's why, if we get more advanced, if people stay on the line, if you really get advanced, more and more people are doing these models month by month by month, and then just having a kind of quarterly or semi-annual is more common, semi-annual payment. But in between that semi-annual period, if you do monthly, you can see, well, we're building up a little cash. We're building up cash until we get to pay the dividend. And when we build up cash, we can stick that money in the bank and get a tiny, tiny little interest rate on that. So you can go, but that's exactly right. There are timing issues okay. And sometimes they matter a little bit. Okay. Very good, Josh.
Okay.
Now let's go down and let's get our cash flow over the holding period. So just don't take the value, but go up to that flag we used for the holding period, way up. It was way up. Keep going up. And the cash flow, that's that flag, and multiply that by the equity cash flow up above a little bit. the one we just took. So you could do this with any of the cash flows, press enter, and that's now this time our cash flow stops in period 6. And then if you go down, let's get the cash flow we get when we sell the project. So you go up to that NPV calculation, just a couple of no, just right above it, just that one in the yellow.
Mhm.
And you just multiply that by the exit period. So the mechanics really, once you get the flags, they're pretty easy. Keep going up. And click on that one, click the sale date, which is 361. Enter. Fantastic. And then you press Shift Control R. So that's our cash flow. It's kind of like a terminal cash flow and all that stuff, and private equity, and just alternate equal, just add those together. And then Shift Control R. And then you go down, and this time, oh, I'm sorry, I computed it for you, but can you see that just press F2, so you see that that's the IRR we get when we sell the project. And the reason we're getting a higher IRR is because of that discount rate being less than the 13%. Now, the issue is, if you press enter, what's the right return you really get as the seller? Is it 13% or is it 16%? And if you're Warren Buffett, you say, oh, my holding period's forever. I'm not one of these horrible people who just goes and buys and sells things and fires everybody and breaks up a corporation, all that stuff. But in this context, you deserve a higher return. You're in a development business. You're doing the hard things. You're getting the thing financed. You're getting it developed. You're taking construction risks. You're taking production risks. And sorry, I have to, you're taking production risks, and you're deserving a higher return. How much should that be? To pretend that 16% versus the 11%. Now that the 11% is when it's kind of boring. The 16% has all the risks in it. If you think you can use the CAPM to figure that out, I think you're a little crazy. But what theoretically you could do is say, look, when we did that goal seek, we should have done the goal seek on this number, not the other number. We know the 11%, something like the 11%. How much more do we really need in order to take all of those risks? And I had never really thought through this issue until kind of this one. Now change that holding period with the spinner box. And this always happens. Make it in the very first thing. If you make it 7, it's going down. Reduce it. So the real strategy is and you keep reducing it, and you see it goes up when you reduce it. And that's just because of the IR mathematics. So those people who wrote up that little case when they said 7 years, that's not realistic. I hear people talking about 2 or 3 years. And they say, after 2 or 3 years, we give you your financial statements, Mr. Insurance Company, Mr. Pension Plan, here's a safe project, buy it. And the question is, how much do you really need? If you're bidding on a project, bidding on the PPA, theoretically, nobody does this, but theoretically, oh, thank you for helping that out. Oh, thank you very much. So that's the seller perspective. Let's go to the one called sensitivity analysis. Could you do that? The rest is just that one. Right click on that thing that says create table. This is a little bit of review from last time, and press assign macro. Now that blue area, and press edit. That blue area has a range name. Could you just make that kind of larger? I named that blue area that you see. I'm sorry, you can't make it larger. You can only expand it. Right. Whatever. The inside, the little one in the middle there. Okay, that one. Right. Very good. So we did that last time. We made a little for loop and cells. We did that last time. This time, what you can do is that output is a whole range name. And in that output, we just go, what we do is we go around that output and you can see, oh, I put a message box. Do you see it says scenario value equals output cells 0, 1. That what that does is it changes the scenario number. Every time you go around, it just changes the scenario number, and then it plops in our pre-tax, our value for the different scenarios with all of those synergies and all that we put in. So right now, I just want to make sure I didn't explain this really well enough. I didn't explain this at all well enough, but let's just run it. It's taking the last thing we did and make it a little more elegant and flexible. So could you switch to back to the spreadsheet and just press that button? So now we're going to fill in those sensitivities. Oh, you have to press OK. I put a little thing. And then what it should do, it goes around and says, with the longer life, here's what happened to the value. And I'm a little bit worried that we have I didn't put the yield we're getting. So we would be willing to pay higher value after we get the synergies. That's the effect of the synergies. I've got something wrong on the reduced O&M one, but that's the idea behind that little case study. And we could use equity value or project value and kind of show how it works. Now let's go to in the next sheet. It's not important, but go to the next sheet. That's just got a little summary of our valuation. How about going back to the summary of our valuation? So that just shows you, can you click on, instead of reduced O&M, click back to the base case? That's kind of interesting how the cash flow patterns are a little different. And that shows you kind of, we could have done this using equity cash flows or project cash flows. And I'm just a little bit concerned. Why is it giving 20.11%? Can you just switch to the financial model for 1 second? Is that, oh, there's the 20.11. Okay, good. Okay. So you could get into fascinating discussions and theoretical arguments about which IRR is the true IRR. I remember one person said, oh, just when you're starting to mess around with all these IRRs, she said, oh, just tell me what IRR you want, and I'll put discount rates and fudge this around to give you that IRR. Okay, I kind of agree with that a little bit. Go to the transaction page. And now we're going to do the seller perspective. Now, the first thing to do is to say, okay, let's put a transaction date. Now, I have not practiced this, so go to F there, and can you just put, if you go, I think I put it in the input C page. I hope I did. In the input C page, if you go down to our valuation assumptions, I put 31 December 30 in line 84. Okay, that's all that is taking the COD date and getting that. Now, if you go down, so now we're just going to go crazy and say, okay, well, let's get our valuation in. And now this is, I guess this is the only thing that might be a little bit different. Can you just go and say this buyer, the seller, is going to not assume any synergies? So we're just going to always take the base case and say we're going to pay this value to the buyer based on his short life or her short life, on her assumptions, and then we're going to put on our synergies after that. So could you go to the sensitivity analysis and just pick out how about the EV in the base case, that 57,640 in line 20, whatever it is, press enter. And then put in the next one, you put an equal sign, get the same number. You could almost press Control D, but just get the next number. Okay, that's our different valuations. Okay, Shift Control Q. How about that? Very good. Oh, see, oh, that's fantastic. Now let's find out how much debt they had in the project. And this time we're going to go crazy. Put equal lookup. And again, this is controversial, but go up to that 31 December date up in line 4, and then put a comma, no F4 needed. Go to the financial model and click on the entire line 9. And then after you click on the entire line 9, put a comma, excuse me, and go down and get the amount of debt that's upstairs. Sorry about that. Get the closing amount of the debt. Oh, right there. No, a little higher. Oh, yeah, you can use that one. Perfect. You can use that one. Press enter. So I hope you're seeing, okay, Shift Control Q. Now, if you would go all the way back to the Input C page, okay, oops, we can't quite do that. We'd have to run the macro again. Oh, let's make it 4 years just temporarily. So just up there with the spinner box, you can even make it 4 years. And then what it will do is, I should have not used that macro, but go to the transaction page. So now it made it 31, and I hope that debt changed. Let's go back to, let's leave it. No, go back and change it to 3 because we'd really have to redo that sensitivity table. So what we could have attached that little macro, that spinner box to that macro. Let's not worry about it. Okay, and then I said, let's decide, are we going to use equity value or enterprise value? And I put an equal sign, and then just go back to the Input C page, and I forgot even what I did here. And if you go down, I said up a little bit, up a little in that. Right there, it says a flag for valuation with that one. Click on that, the true. The next input I put is for taxes. And it could be a taxable transaction. If it's a taxable transaction, the seller has to pay a gain on the sale. The buyer gets to write up the value. That's the simplest way to think about it. If you're just buying shares and it's not a taxable transaction, there are no taxes. It's always better to have non-taxable. But for right now, if it's true, then put an equal sign and just take that true, and we're going to use the enterprise value. We're going to use the equity value plus the debt. Open the bracket. Sorry, open the bracket, Josh. Sorry, you're fantastic. And go to the line 8 plus line 10. Okay, that's our enterprise value. That's a definition of enterprise value. It's equity. So we get a little bit of a different valuation. Who cares? And then did I put a fee percent? I probably didn't put a fee percent. Can you go to Input C? I might have put one in there. If you write down, oh yeah, I put the 0.75%. I just made, you got to pay all the consultants and the big 4 consultants, you got to pay investment bankers, all this fee press. So go back to that transaction page and put that fee percent in. Okay, the accounting for that fee, and then just take that 0.75 and so that we're going to pay that for the enterprise, and then we're going to have to pay all these fees. Okay, and then the next question is, do we assume the debt? Do we buy this without debt, or do we take on the debt? And let's say did I put that in Input C? Did I can't remember. Can you go to Input C? I think I probably didn't put that in. Yes, flag for refinance. Go to that true. So let's refinance the debt. Put an equal sign, and then we're going to refinance the existing debt. If they have any, click enter. Now, if this was like this Osted company, they wouldn't have any debt, and you just buy the enterprise value, and then get the next flag too, which is, are we going to issue some new debt when we refinance this project? Okay, so we've got all the assumptions set up, and then if we refinance the debt, let's go back, and we're going to have a DSCR. We're going to size the debt. Now, what I'm going to do here is, and then just put that 1.2 in. And I think for now, can you just press Control D? Just Control D. Go down. No, down one, Josh. Control D. That should, and then go down one. No, that interest rate didn't work. Put an equal sign and get the interest rate on the new debt. So I said, oh, maybe it's safer, and leave that blank for now. Okay, just leave that blank. We can't compute that yet. I think let's do this a little bit simpler. Can you go back to the input C, and let's turn off the calculation of new debt. And if we don't get to this calculation of new debt right now, so just put a false there. This is a whole big subject. Just type false and then copy that across. Okay, and then we go back to the transaction page, and let's just leave it out, and let's see how far we can get. Now, you could even go forward just for the share price. Just put, for example, the buying company has a 15 lakhs. Just type in 15 for now, okay? And we're going to figure out how many new shares they issue, and then you can have the earnings per share of this new company, the acquiring company, and see what their old earnings per share were, and then you take the earnings we get from the transaction and divide it by the old shares plus the new shares to get this dilution. Let's leave that for now. So now let's just go and do the key thing next. Sorry about skipping around a little bit. Go down to where it says consideration for enterprise. So we need to understand some of these words. Consideration is not how much you actually pay. That's how much you pay for the asset. And put an equal sign and go up and get so we're computing the sources and uses of funds, which is absolutely crucial. Get how much you're paying. Press enter. And then get how much you're paying for the fees. And you just think, how much do we got to pay? And this time we have an assumption of new debt, so we're not going to pay anything. I guess you could put equal NOT, put equal NOT on the flag, not, and go up on that flag for assumption of new debt, the one above, the flag just above in line 19, not 20, and multiply that by the amount of the debt, which is upstairs somewhere. We got that debt upstairs. And I hope what you're saying is, oh, we can do this. And if we change the holding period, it's all going to be all very automatic. And so we're not, this time, since we're assuming the new debt, we're going to not repay it. And then go down and press alternate equal. And that's how much we're going to take out of our pocket. Press enter. And then you do the same kind of thing we've done before. And then since we start with enterprise value, we didn't have to, but we're in line 40, we're going to, if we pretend we're paying for that, but we're really, we want to figure out how much equity we're paying. So go up and get the assumption of all the new debt, which I suppose you could take that true and multiply that again by line 19, the true. There would be 1,000 ways to do this. Please don't assume this is any kind of formula. And then the new debt is put an equal sign and go up to line 26. We'll get the new debt computed. press enter. And then we'll get the equity, which is the difference between how much we have to spend up in line that one minus how much we're getting. Okay. Press enter. It's just like kind of and then you can
Ed,
press alternate.
can I ask you something here?
Yes, please.
Looking here, since we have existing debt, then why we don't have repayment for the existing debt?
I'm just saying sometimes you could take on the existing debt if it's project financed. So we're just saying we're going to leave the banking the same. We're not going to pay all the debt back and issue new debt. Or you could do exactly what you said, Abdul. Like you could do the other way around. So for now, I'm just pretending that we're going to assume the new debt. We're just going to keep repaying the existing debt. So we want to do it both ways. And I think what's going to happen is I'm going to run out of time. So we're going to just do it this way for now. And let's go down. But the key point here is if you're going to make a little model of the acquiring company, I couldn't do it without having a separate little page that goes through this. Now for accounting, if you go up to the go to the enterprise value and go up and get the enterprise value we're paying, that's totally fine. And then press enter and let's find out how much the book was on the books. And you put an equal lookup again. We put lookup again, and you go up to that date. And then after that, you put a comma and you go all the way to the financial model. And then again, look up on the end date. Very good. The whole line 9. And then go down to put a comma and go down to the balance sheet. And then keep going down. I could not imagine doing this with H lookup, by the way. I couldn't even up a little bit higher and click on line
17.
I think 317 is probably the best. You're right. I was going to say 315, but the accumulated IDC and everything else. Press Shift Control Q. So that's a net increase. Put an equal sign. Now that's gonna that has to be on the balance sheet somewhere. And if you just pretend for a minute, if you would pretend that that's the true fair market value, just put 10,000 in line 50 just for temporarily. You put 10,000, Shift Control Q just to show that we really got it right, and then put an I'm sorry. The fair market value would be put 57,000. Sorry about that. That somebody does some kind of assessment of the value. You get some kind of valuation. Put 57,000. That's related to the more like the enterprise value. And then you take away the book value again. And that's the goodwill, the minus. Now, realistically, you'd never do this. Goodwill is supposed to last forever. This asset is depreciating and will be finished. So what you're really going to do is just go up to line 50 and just for the fair market value, just take the enterprise value. Okay, so that we've got a write-up in the value of the asset. And for book purposes, we're going to depreciate that amount. But for tax purposes, that depends on whether you're buying the assets or you're buying the stock of the company. If you're buying the stock of the company, you don't worry about you just leave the old taxes in. If you're buying assets, that's just based on the tax rules, then you get a write-up in the depreciation. For now, we're just gonna let's leave that alone for a minute and just assume a tax-free transaction and kind of look at some book accounting. So go to the acquirer model. Now, when we go to the acquirer model, we're just going to make a whole new model of this company. And the first thing we got to do is we got to say, okay, where it says transaction period, and I have not practiced this, but go to column F, put an equal sign, go to column F, put an equal sign and get that transaction date. Okay, press enter. And then could you no, I'm sorry, just put for now I'm sorry, Josh, just put 0, just type 0 in there for a minute. Go up to that 31 December, up to the 30, just type 0. Okay, and then just you can press Shift Control W on that. Go upstairs and press Shift Control W. And just this time, make a flag. It's kind of like our construction flag. And I hope you're seeing if you're in value, go forward and just put an equal sign, go up to the 0. I just made a simple little counter and put an equal and go back to that 0 in column F, in column F. Down that one, that one above one, one above. We're all press F4. Just this time, just leave it. Shift Control R. Let's just leave it as true false for a moment, okay? And then let's put now for the months in the period. Could you go and I'm cheating now. I'm sorry, but in column F, put, if it's the transaction period, go back and leave that a 0 actually, and or just put 1. Just put 1. I think we might have to, and then go forward to column G. We've got an annual model just like we did before. So we're just going to put 12 there. I didn't put a sum column here. Sorry about that. Go forward to column J. And just put equal. If it's true, that's exactly what we did with our timing. Up. If it's true, up 1. Put comma, and then go back and click on that number 1, F4. Otherwise, make it the 12. So both of them have to be locked because they're both taken from the side over there. Okay. And the second one, very good. Okay, and that's what we did. And how about for this time, go to the start of the period, and I should have been having you know, what we should be doing here is in E6, put the word months in E6, just because that's our unit for what's coming from our constant. Shift Control D, remember that? Okay. And then go down and put a date in. So let's just put our, and put a date in the end of the period too. Control D or whatever. Yeah, okay, very good. And then go to this time go to E8. Go up, go forward to the constant, go to column F. Put an equal sign, and then go to the transaction page and get that transaction date. Okay. And I suppose what we really could do, if somebody's got a better answer to this, let's go and put, let's go to column J and put our transaction date in. So how about using an if statement? Put an if statement if it's the transaction period. So if it's true upstairs, then do a comma and put that one and press F4. Otherwise, take it's gonna take the prior year, go up 1 and back 1 and back 1, and so that's the prior year starting balance, and put a +1. Okay, that's maybe not very elegant. There's probably, and Shift Control 3, right? Is that what you had to do to get the date format? Not Control. Very good, very good. And then how about this? Let's do the same thing. Go up to the up 1. Put an equal sign. If it's true, we're going to put the transaction period in. Again, maybe I should have put that in on the side there, but this time just cheat, go to column F and get that transaction date. F, and go down one. Then press F4. Okay. Otherwise, if it's not true, the opening balance is the prior period closing balance, down one and back one. Press enter. So now we've got our dates set up. I'm sure we could have done that a little more elegantly, but who cares? Shift down, Shift Control R. Now I think I did this wrong because we started and go down and go down to the end date. I should have instead go up instead of that should have been instead of J plus 1, it should have been EO month. So take that J plus 1 away and put EO month. Take the EO month and go up one to the start period date. Just go up one in and then put comma, and then you go to the number of months up there, the number 1, and put -1. You have to put a -1 in there. Okay. And hopefully press enter, please. Shift Control R. And I was wrong, wasn't I? Because that start date go up. We've got one more thing to do. That start date go up one. That should have been +1 at the very end. We should have put +1 at the very end. I'm making these, of course, everybody knows I'm making these mistakes on purpose, so you can see what to do. So at the very end, put +1 on that I8 at the very end of the if statement. Inside. Press enter, okay? And Shift Control R. Okay, so now we've got our nice timeline built. And of course, if we change the transaction date, everything's going to change. Everything's going to change. And now, if just to kind of illustrate how this this could work is, let's go back to the financial model and grab the little drop-down box. So right click on that one, copy that, and then go to the acquire model, paste that way at the top. And so what we can do now is that the timeline is going to all change. But remember, we had the second scenario we had is a longer operating life. So if you go to the second scenario, go up to the drop-down box and change it to the longer life, then we want to see what happens to the financials, what happens to the value of the company, what happens to the acquirer IRR if we have these synergies that Case talked about. For the operating period, here's what we're going to do. We're going to go crazy with this. And if somebody would not use this, I don't quite understand. Go down to the operating period in line 9. And what we're going to do is grab a whole bunch of stuff from our base model. So what you do is you just put equal, I guess, lookup. Okay. And then you go up one, and then put a comma, and then go all the way back to the financial model. And you click on the end date there, and then you put a comma and click on the very next one, which is the operating period. So we've already changed the life in that model, and we've already changed all the assumptions in that model, Shift Control R. Now, I suppose what we really should have done is multiply that by not the true at the very beginning. So just at the very end of this, put a multiplication, go up one, put a very good, put a multiplication and put not the transaction period. Now, once you've done that, click on that, then you get the idea. Very good. And I never used to use not much. Of course, it would work just as well. Shift Control W maybe. just to get rid of those dates. Okay, and now if you, you know what I didn't do, which is so horrible, go to column H. This is the big crime of the century. Go to column H and insert a column, and we should always have the sum. I can't believe I was so, insert a column. Control space bar, and then shift control plus. Wow, Josh. I hope you, and Abdulhaki is the same thing. If you just practice and just practice this stuff and go up to H2 and just put the word sum up at the top. And that for me is the absolutely crucial thing to do, is to get this thing structured a little bit okay. And then you go down to column 9, or row 9, sorry, of course, and put shift control V for Victor, or just get that. And no equal sign, no equal to off out of the cell. Very good. Just okay. And oh, that seems to be one too many. I'm going to leave it for now. Ooh, why did that? If you go all the way back to the financial model, how many? What was our sum in the financial model? If 35. Oh, that's right. It's right, because we've started acquiring. We don't have the full life yet. I was thinking it would be wrong, but I think it's okay. I might be off by 1, but okay. Okay, very good. All right. And so you see that we could change the holding period. Now there's one problem with all this, that sensitivity little thing we did. You know, let's do this. Could you could you go back to the financial model for a minute and get that little, how about input C? Get the little spinner box in 83. Right click on that one, copy it, go to the sensitivity analysis page, paste it there. Okay, and when you paste it there, right click on that data table, the big macro there that says data table. You see where it says create table? I'm sorry, it says create table. And go to assign macro, and you see if you press edit, you can see it says table 1. That's all we needed. It says table 1. And now click, go back to the Excel. Sorry about that. Go back to the Excel. Right click on that little drop down box. Right click on the drop down. That one you just copied in. The little
the spinner.
Spinner. Sorry, spinner. Oh my God. Sorry. Thank you. Go to assign macro. I'm really getting to be degradation. And go to just type table 1. I think, or no, the best yet is where it says all open workbook. Switch that to this workbook down at the bottom where it says macros in. Way down where it says macros in. Way down there, down further, down below that little window. The next thing, all the way down. Keep going down. No, it says macros in. Way down.
Macros in.
It says all open workbooks right now. Below the
yeah.
Oh yeah, just put this workbook.
Okay.
And then find the one that says table 1. Okay. So now if we press OK, and so this time if you change the let's change the holding period. Let's make a longer holding period. Fine. Put it up. Yeah. So now, and press OK, I put that silly little OK thing down. And then it's redoing our valuation, because if you're the seller, you're going to sell it differently, and the buyer, because you've got a different year. And then you could right click on that thing again. Now, I hope this will work, and copy that. Let's copy that to the transaction page. And this might not work. Just paste it there. Okay, and we should have kind of put what the holding company is. Could you push that up or down, see if it works?
Oh yeah, sure.
And just see if it works, and press OK. So now we've got a different valuation, everything's the same, and now you could copy it. It's taking a second because it's doing the data table, and you could copy it also to acquirer model. Okay, so that's how we can do some, if you can, we're doing some M&A analysis. Okay, and now what we'll do, again, I'm going to stop in 15 minutes. Maybe what I'll do is finish this up because it'll start getting easier. But let's get our revenues. So let's go down to line 12 and get our revenues. And this idea behind getting a timeline set up is so crucial. Put equal lookup again. And then go up to the end date, because now we have a different end date, and put a comma. And then you go back to the financial model, which is your kind of valuation model now, and then put a comma, and then go down to up. And let's go way up to the top. Let's go way up to the top because we kind of started with revenues. Yeah, that one would be okay, I guess. But we put it way up at the top. There, it was CapEx, revenues, and OpEx. And go down to line 49. Just click on the entire line 49. I think maybe next time, if anybody has a question, and press Shift Control, multiply it by not the transaction period. Perhaps we should have made that, almost up the true. It's the true. It's a very first, that one. Very good. Shift Control R. I love what you did. Shift Control Q, maybe. Does that work? That will kind of, and then we'll do the same. Let's go and do the same thing with the OpEx. Okay, and then that's not going to work. So what you
we
could
just
do,
get the numbers.
What you could do is careful. You could lock in this was we'd have to
And period,
lock.
maybe. Yeah?
We'd have to, yeah. Very good. You're doing it fine. Sorry about that.
So
I thought
we had the revenue, and we can just get to 41. So I guess
it's very good.
we come here and just change
Yeah,
this to 41.
Totally right. And I thought you'd have to lock in the K8, and you don't, do you? How did you do that? I would think
I just copied the formula.
But I would think K8 would go down to K9 in the next one.
But no, it's because I came here and I copied it.
Oh, I see. Okay. Oh, very good. Okay, very good. I like that. See, I learned that. Oh, very good. And the depreciation, we can do the same thing with the depreciation.
Yeah.
Okay. And then
so for 72.
Yeah, very good. Oh, perfect. Oh, very cool. Okay. That's exactly the approach. That's the big thing to tell you. And the other big thing to tell everybody is, I hope they're not saying, oh, I'm not an investment banker. I can't do this. It's too advanced. The hard part was getting the fundamentals about that project defined. Once you get this defined, then you can start putting all these things together. And what you just need to do, how about let's get the depreciation rate. The reason we're going to get the depreciation rate, let's first go up one. Okay, we could, no, I'm sorry, go to H, get the sum up there, go up one. Down to the depreciation, shift Control V for Victor, and then go to the line 15, go forward, and just take that depreciation divided by the total. Put a percent there. Very good. Okay, good. And then go forward to K, and just put an equal sign. Go up one, and divide that by this, and F for. Okay, Shift Control P for getting a percent. Okay, very good. And if you get the sum, that better be 100%, but it's in line 15, just to kind of check that. Very good. Okay, and then so now I forgot, what did we do? We assumed the existing debt. You remember that we said, okay, we're going to have to pay off the existing debt. So I think what we'll do next time is we'll put new debt in and talk about debt sculpting and everything else. So let's at least get this done. So can you do one more time? You're going to copy it again. This time, would you mind going up? Would you mind going up to line 14? In line 14, could you just lock in the K, the 8, but not the K in the very beginning, the very first thing?
Yeah.
Just lock in and then lock in the 9 on the next one. Press F4, just press F4 right there. It should, good. And then lock in on the 5, not the K. And you can just press F4 a couple of times, then copy that down to the existing debt payment. I'm sorry, that's how I do it. And then I did it wrong. What did I do?
Because you still have to go and get
You're
this.
supposed, I'm sorry, we should have locked in the K8, not the other one. So there should be no $sign on the K at the beginning, only a $sign on, and change that 11 to 8 and put the $sign on the 8. Sorry about that. And then that's okay, good. Sorry about that. And then very good. And let's get so you go up and do exactly the same thing. We're going to change the 75, press F2 maybe. I think your method is better now. I'm sorry about that. Change that, take that 75 away and find in the financial model the repayment of the existing debt.
Sure.
Which is there. Keep going down just a little bit further. Right there.
Yeah.
So the repayment is 140
and 142
is
no, it's 143. 140
okay,
and
very
143.
good. Okay, very good.
Okay.
I think your method was better. Okay, that teaches everybody you should have an open mind. Try whichever thing works, and then find the laziest way to do it. That's the whole Excel idea. Okay. And very good. And now we're going to just start. Now, I really wanted to get all the way to the balance sheet, but I think after we get this IRR, it'll be a good place to stop. You could even go and start trying to do this yourself. But what we'll ultimately do is put the new debt and the existing debt in together. It'll all start looking the same. Fantastic, you're doing this, Josh. Thank you so much. So let's put an equal sign and get the EBITDA, the revenues minus the expenses. Okay. Shift Control R. And then we have to pay the enterprise value. So how about going to column F and just getting our enterprise value, go all the way back to column F and get our enterprise value from I think we used the other one, from the sources and uses. Almost, if you could do it from there, but it's really good to take it up there in line 34, to take everything from the sources and uses. Oh, you could get it from there too. Either one, of course, is fine. And then just put that in. So that's kind of less our CapEx, put an equal sign, go back all the way and get that number and lock it and multiply it by the little flag we have for the transaction period. Okay, and then you can do the same thing with the fees. So go to column F, get the fees in column F, and do the same thing, multiply that fees by the transaction period again. Okay, and then our net cash flow is what we get in EBITDA minus the next ones. Now, accidentally, it says reduced O&M. I think I did my sensitivity analysis. Let's do something again. Shift Control R. Okay, could you, because we're really finished, and then how about computing the XIRR? And I suppose you know, if you're just doing this, this would be like you know, if you have a classic kind of annual model, you could certainly argue that this should be uh, uh, we should have taken a half year kind of thing and done it, adjusted the dates to a half year and all that stuff. But just as long as I think we've introduced that, that's good enough. I made a mistake. Go to the sensitivity analysis and make sure that we're starting and we're going to pay this company based on their base case. So maybe could you go to the financial model, copy the base case into the no, just copy that drop down box. This time it's a drop down box, right? Copy that to that page up at the top anywhere you want. Good. There is fine. Okay. And then let's put it back to the base case to get our kind of valuation for the base case. Is that working? Yeah. And then create the table from the base case, press OK again. And what that does, all it does is that blue area, you can just look at the macro, I hope. See that it made a blue area. That's a range name for the blue area. We're going up and changing the scenario number from 1 to 2 to 3 to 4 to 5, but we want to take it from the base case, which I think we did already. I was wrong. Okay, I was a little bit wrong. Now go back to our acquirer model. And in the acquirer model, can you switch it up at the top and put let's start with the base case.
But shouldn't it have already updated here because it's all coming from the same dropdown?
Yeah, it's well, yes. I'm just seeing what kind of IRR we make in. So if you go up and make that the base case,
yeah,
then then it's not exactly 10.4 because of that adjustment we made for the half year business. Okay, perhaps I should have done that. And now we can see, oh, that's how we're going to buy this model. And then if you put the second case in, remember the financial model changed, and that changes this model. And we see if we could get a longer life, let's see what our IRR is. Again, it's going to be very, very similar to the other case. So that we're going to pay it based on the base case. Now, you could, of course, make any assumptions you want. I'm just demonstrating some things, and it's kind of interesting. It's going a little slowly now because we got a lot of crap in there, I think, and that's how much our IRR goes up if we get this kind of synergy. And you could make all your sensitivity diagrams and do all that kind of thing. And that IRR, we should have called that we should have called that if you're fancy and a investment banker, you call this the ungeared or unlevered pre-tax IRR, something like that, where it says IRR in line 25. Let's just be a little bit careful with that one, okay? And then what we're going to do is put in different debt structuring, okay? But I think, and I've got Abdul Aki to thank for, he says, you can't go too long. This is, I've got a weekend. He's on holiday in Antalya, and
Thanks,
we can't
Ed.
go. We're gonna stop here. And the nice thing about this is last time Yash was so nice, he actually sent us the file. So we'll send the file, and then we'll talk about restructuring the debt. Now, when we talk about restructuring the debt, we're instead of doing it the way we did it last time, we'll do some of this debt sculpting and get a little more advanced. So I'm stopping now. And again, what was wonderful last time, what was really wonderful last time is people made some suggestions, especially this suggestion about doing a little valuation. For me, there's a lot of theory behind this, It's a little bit softer than doing all of our standard project finance models, but you can see kind of how to put things together. So any questions or comments? And if not, that's fine. We're just going to have a good weekend.
Thanks, Ed. It was super nice, very fast, and I think now we need to exercise.
I'd see. That's good. Okay. Okay. Very good. Okay. Oh, great. Thanks.
Thank you so
Okay.
much, Ed. That was one. I never looked at it this way. I
Okay.
never done this part at this, looking at it from both sides. It's very interesting.
Okay, very good.
Thank
Thank you
you.
so much. Okay, very good. Thanks. Okay.
Thanks, Ed.
Great.
Enjoy the weekend. Bye-bye.
Okay, see you. I think next week
Thank
we'll
you.
have a session. I'm going to be at my
Thanks, Ed.
uncle's in England. Okay, bye.
Bye-bye.